Hey folks, it's day 55 of the Storage 100 series. I'm Joe Downs with the Storage Moguls Mastermind, and the topic of the day is debt service coverage ratio, or DSCR. Folks, this is the bank's favorite number, and it should be yours too, because understanding the DSCR, it's not that hard to say, but I'm fumbling it tonight. Understanding the DSCR is crucial for securing financing and ensuring the health of your self-storage investments. It's a simple ratio, but it tells a very powerful story about your property's financial strength. So in this episode, I'm going to break down what it means, why it matters, and how to make sure your numbers look good to lenders. All right, so let's get started with the basic definition of DSCR. So what exactly is it? It's a fundamental metric in real estate finance. DSCR measures your ability to pay your mortgage from the property's net income. It's calculated by dividing your net operating income, or NOI, from your annual debt service. So NOI is your property's income after operating expenses, but before debt payments or debt service. Annual debt service is simply your total mortgage payments for the year. So this ratio gives lenders a pretty clear picture of how much cash flow your property generates on a net basis relative to its monthly or annual debt obligations. So, all right, let's now we know the definition. Let's talk about what that magic number that they're looking for is. So when it comes to the DSR, there is a magic number that most lenders want to see, especially in the early years, and that's 1.25x. And what it really means is 1.25 times. So they want to see your income 1.2 or your net income 1.25 times your debt service. So for every dollar of debt you have, you need your property to generate 1.25 or $1.25 in income. So sticking with dollars, if your annual debt payment is $1, then you need to be bringing in $1.25 in income, because that extra 25 cents provides a crucial safety margin for the bank. It shows them that even if there's a slight dip in income or some unexpected expense, you can still comfortably cover your mortgage payment, also known as the debt service. So this safety cushion protects both you and the lender from any financial stress. It's not just a random number, by the way. It's a standard, pretty much standard in the industry, that reflects prudent lending practices. All right, so let's look at a quick example. See this in action. Imagine your property is a net operating income of $125,000, and your annual loan payments or debt service is $100,000. When you divide $125,000 of net income by $100,000 of debt service, you get a DCR of that magic number of 1.25. This is exactly what the bank wants to see, and your loan would likely be approved. It demonstrates that your property generates enough income to cover its debt with a healthy buffer. This is the ideal scenario. It shows financial stability, low risk. What happens if that number doesn't hit the 1.25 though? Well, let's say your NOI is $100,000 and your annual loan payments are also $100,000. Well, now you got a 1-to-1 ratio. Your DSCR would be 1.0x, right? 1 times. This means you're just breaking even when you look at your debt service, right? There's no safety margin. So from a lender's perspective, this is a high-risk situation, and your loan would likely be rejected. Break even is simply too risky. Any hiccup in operations could lead to a default. So if your DSCR is too low, what can you do to fix it? Well, first, you can increase your net operating income, or your NOI. This means either raising rents or cutting expenses, both of which directly boost your property's profitability. Another approach is lower the loan amount. By putting more cash down, you reduce the debt service, which in turn improves your DSCR. Lastly, you can work on lowering your interest rate. Sometimes buying down the rate or negotiating better terms can significantly reduce your monthly payments. By the way, you can do all three. These are the levers that you get to pull out, to play with, to get your DCR to where it needs to be, assuming it's achievable. But remember, the bank isn't just looking at the property itself. While we focused on property level DSCR so far, the bank's also going to look at you, or your global DSCR. This means they're going to look at your entire financial picture as well, not just the properties. So your global DSCR combines the income and debt from the property with your personal income and debt. And it's about the total financial health of the borrower. The idea is that you need to be strong personally to support a property that might be weaker. This gives the bank a complete understanding of your ability to repay the loan. So while improving the property's DSCR is crucial, don't forget about your own personal financial standing. Understanding global DSCR helps you prepare for the bank's comprehensive review. All right, now let's see how DSCR stacks up to another important metric, loan to value. It's important to understand the difference between DSCR and loan to value and how they work together. All right, so loan to value, or LTV, limits the loan amount based on the property's price or appraised value. DSCR, on the other hand, limits the loan based on the property's cash flow. So the bank will typically use whichever of these two metrics results in a lower loan amount. This means you need to satisfy both criteria to secure the financing you want. So even if your LTV looks good, a low DSCR can still cap your loan. So you can't just focus on one. Both are critical for getting the deal funded. This dual consideration ensures the bank is protected for both overpaying and insufficient cash flow. All right, let's wrap up with a crucial thought about respecting your margin. And that is my thought for you today, folks. It's always important to respect the margin. A 1.25 DSCR isn't just a bank requirement. It's a fundamental principle of good business. It means you have a buffer, a cushion against unexpected expenses or dips in income. Never buy a deal that doesn't have a healthy DSCR margin or no margin at all. Things rarely go exactly as planned, and that margin protects you when they don't. This financial breathing room is what allows you to weather the storms, and you will see them, and also to capitalize on opportunities. It's about building resilience into your investments. All right. Always prioritize deals that offer a healthy margin. All right, folks. If you found this information valuable, please like, subscribe, and share. Sharing helps us reach more people who can benefit from these insights. Hey, and connect with us on our social medias. Stay up to date. And we're always putting out new content. You know that. So make sure you subscribe so you don't miss it. Because this content, I'm hoping, is what's going to help you succeed in self-storage. Oh, and definitely share this video with someone you know who might be considering buying a property without fully understanding DSCR or how it relates to the loan to value. They'll thank you later.